What a day in markets it was. We are looking at the third consecutive day for losses in these stock markets today. They're not as bad as they were earlier in the day, but nevertheless, it looks like things are getting soggy. So, is this the turn that we've been waiting for, or will this be bought up like every other false start lower for U.S. equities in recent months? That's what we're going to tackle here on Macro Money. I'm Ilya Spivak, head of global macro here at Tasty Live. And what we're going to start with is, as we usually do, a look at the economic data in context of the market performance and what that market performance is telling us from here. Needless to say, there's once again a little bit of U.S. event risk on the menu, but we'll start with how these markets have performed, and the picture here relatively soggy. Another down day for the S&P 500, another down day for the Nasdaq. They're both off about 0.4% ultimately, but that is much less severe than what we ultimately were looking at earlier in the day for the S&P 500. Just by way of an example, we were down as much as 1.1% earlier. And if we take a look at the same for the Nasdaq, there the swing was even more dramatic. We were down 1.3% intraday from the open into the low, and obviously we've moderated those moves significantly. We can continue to see here that yields were higher, the 10-year up, the front end though looking more potently on the upside, 1.5% for the 2-year. Gold eking out a fractional gain. Silver was more buoyant, as a matter of fact. But on top of this, Bitcoin doing its risk appetite on steroids thing and ending up with a loss of a whopping 3.89%. So really looking quite beaten up here. And if we consider this sort of in the context of how these things have performed this week, we can see there's definitely a theme that is emerging. So stocks ultimately, so far this week, down almost 1% for the two major indexes. Rates up across maturities. Gold, again, a little bit higher, but it was higher earlier in the week. It's moderated from those earlier gains. It's cut them by about half, but nevertheless still sort of clinging on to gains. And that's certainly despite the higher yields and also despite a stronger U.S. dollar, which now looks fairly convincingly higher against the major counterparts, up 0.75% against the euro, up 1.25% against the yen, the more kind of yield sensitive, the most arguably yield sensitive of the dollar's pairings. And you can kind of see that in the story that you see in yields. Generally, when U.S. Treasury yields go up, the yield differential between the dollar and the yen widens out. And because the yen sort of has perennially low rates for the past 30, 40 years, Japanese rates have hugged zero. There is a kind of natural inclination for the yen to lose, and lose most significantly when U.S. yields are marching higher. And that, of course, is exactly what we have on display here. Now, the bulk of the dollar move, and we'll get to attempting to reconcile some of these others because, of course, gold being higher and yields and the dollar being higher at the same time that stocks are down, that doesn't so much paint a story of only higher yields and only then a stronger dollar on that basis. There is a larger sort of risk aversion flavor here. And the strength of gold, in particular relative to the weakness of Bitcoin, tells you that this is increasingly becoming a sort of risk on, risk off kind of a dynamic. Gold finding support here then on give or take haven grounds. Gold is not the strictest of havens, but it is oftentimes a kind of reflexive thing that people buy at times of uncertainty, and does seem like that's what's going on here, because not only are we looking at higher yields and a stronger dollar, which typically is kryptonite for gold, but higher gold in tandem, sort of despite those things. But the move in dollar here and in yields very closely anchored to what we saw on the economic calendar, and what we find is that GDP was revised higher in the final look at second quarter data. The expectation was 3.3%. That was the initially reported number. We ended up with 3.8. There was a slight revision lower on the prior month, but that ultimately is not anything that the markets really ran with. Instead, what we end up with is a dollar that surges as we get this GDP data. Right alongside it comes a surge in durable goods orders. Right alongside that come a set of jobless claims numbers that seems to point toward better support for labor markets, at least sort of nominally speaking in this report. We can see here on both initial and on continuing claims, we end up with lower numbers than expected and lower numbers than we've seen for a while. Here is that GDP report, and probably the most interesting thing here is you get a slight upside revision for consumption. That's to some extent what you want to see. The consumption component here edging up, but nevertheless, the overall performance from the sort of consumption side of things not looking terribly encouraging, as we've pointed out. If we look at the contributions to overall GDP growth and consider sort of how much consumption has added, certainly there's been a meaningful improvement in these numbers. The new numbers showing us that of these 3.8% consumption, which is 68% of the overall economy, added 1.68%, and that's no doubt a meaningful improvement over the 0.42 percentage points added in the first quarter. But it is also the weakest contribution since the first quarter of 2024. And if we take these numbers collectively, so the first quarter and the second, we still end up with some of the weakest consumption that we've seen in 3 years. I mean, the last time we saw something comparable was back in the third quarter of 2022, the fourth quarter of 2022. Now, this is much better than these figures looked at first. We were looking at the worst 6 months since the first 6 months of 2020, not just the worst in 5 years, but the worst since the COVID lockdowns, which is obviously an ominous kind of sign. On final revision, this is looking better, but it is still the weakest performance from the most important part of the economy in just about 3 years, a little bit less. And so what we have here still looks not great, and much of the swing here coming, much of this dramatic swing from a first quarter decline of 0.6% to then a 3.8% surge, much of that coming from what's going on in imports and the response to these tariffs. In the first quarter, imports shed 4.7 percentage points from the overall GDP story, and that's largely because imports get subtracted from GDP, and in the first quarter, in the front running of these tariffs, the import surge really took a big bite out of overall output. Imports then collapsed in the second quarter because that front running of tariffs really made no more sense once the tariffs were instituted. And that collapse in imports took off, or that took off almost 5% in the first quarter, added a little bit over 5% in the second. It's a similar story for inventories. So inventories in the first quarter here were a major source of swing in GDP. Of course, all of those imports for front-running the tariffs went largely into inventories because they weren't servicing current demand. They were stocking up on goods at the pre-tariff rate. So inventories jumped 2.6% in the first quarter. They fell 3.44 percentage points in their contribution to GDP. So the way you arrive at this 3.8 number, much of that is the revision in consumption, but more than anything, it is sort of the difference between a 5 percentage point contribution from imports falling and a 3.44 percentage point negative impact from inventories declining. That, of course, tells us that under the surface of this data, there is a bunch of moving around relative to these tariffs. But more importantly, in this upside revision, what you appear to have is some implications for near-term Fed policy looking less dovish than expected. And so, too, is this view on jobless claims. We can see here this is a 4-week low right here. So the third consecutive week that jobless claims at the 4-week average are down. And obviously, this surge in durable goods, although it is only a month-on-month number, so it is quite volatile, but against expectations of a decline of 0.5%, 2.9 looks like a relatively potent jump. In fact, if we consider this in context, while 2.9 is not exactly the biggest increase, by comparison, in May, durable goods jumped 16.5%, but it is the first rise in 3 months. So there is something to be said for that as well. And we can see the impact here, the outlook on Fed policy looking less dovish now as we've made the move here. And as we can see, while there's still a disconnect with what the Fed has on the menu, this is the latest from the summary of economic projections that we got just last week. And of course, what you see here is a situation where the Fed is still only forecasting a single rate cut for next year, despite the fact that it's essentially given its agreement on there being 3 cuts this year, which the markets already had largely baked in before the policy announcement. But when we then compare what this looks like with the market's outlook, it's still, needless to say, more dovish in the markets, but meaningfully less so. We're down to just 91 basis points in a cumulative rate cut effort between now and the end of next year. And perhaps most potently, we've worked down the outlook for next year, where most of the easing was, down to just 59 basis points. Now, that's still way more dovish than the Fed's view, which is only a single 25 basis point cut. Nevertheless, it is also the least dovish that the outlook for next year's policy has been since the middle of June. So, in excess of 3 months here. And when we compare then how this looks for this year at 31 basis points, this is of course net of the cut that's already occurred, we're looking at the least dovish since basically the beginning of September. So the markets are looking at this data and they're saying, okay, well, the Fed has less scope to ease. And so they're sort of slowly shifting in the Fed's direction. And when we look at the way that this has looked in markets, we can see here's this initial 25 basis point cut, along with signaling from the Fed that ends up looking less dovish than anticipated. We've, again, seen the Fed only forecast a single cut for next year, whereas the markets clearly have more. And so they've started to adjust this way. We can see, as a matter of fact, right here, that if the base here was around 140, that minus 25 basis points should still give us in excess of 100 basis points in the overall outlook. So it should end up at least 100 basis points priced in, and then about a 15 basis point overshoot, which makes a fifth cut in the sequence about a 50-50 shot, a little bit better. But instead, we've come in much more. And so this would be the markets actually shifting to a more dovish footing, or a less dovish footing, rather. And so what we can see is as the markets digest and as the dust settles on last week's policy announcement, this starts to really weigh on stock markets. And this is where we get this turn. The dollar, of course, following the same sort of thinking. We can see initially a little bit soggy, but now as we get less and less dovish, the dollar starting to really perk up. Now, the next inflection point in this story, as we said at the top of the show here, is going to be U.S. inflation data. And this is the PCE index. This is the Fed's favorite inflation gauge. The expectation is that we're going to come up to a 19-month high on core inflation at 3%, and a 17-month high on headline inflation at 2.8%. Now, on some level, this should not be inherently market moving. First, because the PCE data is relatively well forecasted. Generally, once the CPI and PPI numbers are out, the internals of those figures can be reconstructed for a very accurate forecast of PCE. And so the markets rarely get this wrong, so there's rarely a wedge between expectations and reality that then allows for speculation. But if we look at the way that this has performed relative to the Cleveland Fed's baseline forecast, we can see here that over the past several months, basically going back to shock of shocks, April, where we know stock markets bottomed and kind of the Liberation Day fear was tested, and markets ultimately resolved that the administration is responsive to market discipline, and so we're not looking at the worst of all possible worlds vis-a-vis tariffs and global financial stability. But nevertheless, since that time, we can see realized inflation, headline here, core here, has overshot these forecasts. And that's been going on essentially since we set this low. So let's call it 4 months at this point. And so as we look at this then, the risk is that we might overshoot. Now, for July, we basically came in right on the screws. So no big surprise there. But clearly, we have seen a little bit of a wedge between forecasts and reality open up here. So the risk would be that you get an upside surprise, which wouldn't be particularly helpful given these dynamics here. We can see that the 3-month annualized reading for PCE has been accelerating since May, whereas the 6-month reading has basically held steady. So the dynamics for inflation here aren't helpful if the market is in fact getting worried about tightening, or at least about relatively less easing than it wanted to see. If the market is being forced in the Fed's direction here, let's recall that the Fed upgraded expectations for growth and for inflation, downgraded its outlook for the jobless rate against the backdrop of these rate cuts. In other words, the Fed is trying to run the economy hot, basically betting that inflation will be short-lived, whereas supporting the labor market is where the focus needs to go. If we follow the dynamic here and we get another upside surprise on this, that ultimately makes this look worse, that is to say more inflation and stronger 3 and 6 month dynamics on price growth, well then it's going to be that much harder for the Fed to justify more easing, and this probably has more room to come in, both here and here, which then, of course, seems to portend weaker stocks, seems to portend a stronger US dollar, and generally an extension of these dynamics here. Within which context, then gold and Bitcoin look like interesting opposite sides of the same coin, where the risk aversion becomes the more important thing than any kind of anti-dollar, anti-fiat alternative store of value dynamics, where Bitcoin is taking its cues from stocks and is coming down, whereas gold is finding that haven bid despite higher yields and a stronger dollar and is edging up anyway. And that is macro money for today and for this week. We'll be back on Monday as ever, right after overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I'm also writing for the News and Insights portion of tastylive.com and commenting at Ilya Spivak on former Twitter and on Blue Sky. If you're watching this on YouTube, like and subscribe. And we'll be back with you next week to try and figure out what's next. Happy trading.